So what's up next is an omnibus of those videos I've been doing this week since the last omnibus. So those of you that only saw one and missed all the other ones can see them all together. So here it comes, but before that I just want to say a few things. So I hope you like my thumbnail saying my investments in ruins, and I hope you're not getting any wind noise from here because I can hear wind whipping past my ears. But anyway, we have Bitcoin on a run, 125,000 as I speak. So we'll see. The bulls will say this is going to a million, billion, trillion now, and in my mind this should be pretty much the top, but we'll see. The actual chart of Bitcoin is pretty strong. I'm just, not really a fan at the moment. It's quite nice. Ethereum's running, so that's good. Still got bits and pieces of that. Binance Smart Chain, which is a favorite of mine, which I don't have much, but enough for a decent meal out. Outside of Bitcoin running, obviously it continues to be very strong for metals in general. Gold, silver, copper, they're all going, and platinum, palladium, they're all on a run, so that's nice, and all the stocks that go alongside them are on the run too, so that's nice. So it's just a question of, where is the top? Is this the beginning, or is this the beginning of the end? I don't think it's the beginning of the end. I think that gold can go well over 4,000. 5,000 I will start sweating, but we're probably quite some time away from that. They're after me. And then platinum and palladium, well, I think I've got a long way to run. I think it's quite possible for silver to get to $100, but we will see. So Intel again, 50 to 60. So we're sitting pretty right now, very pretty indeed. Well, that was a long way around, wasn't it? There we are. There's some pillars for you. I just got a quick rant. Now, a lot of people watching this will be very bearish to the dollar, and probably in lots of equities. And they will probably want to find a way of staying in equities, but also being short the dollar. Now, there's a very simple way of doing it. This is what you do. You go onto your investment platform and you pull up all the ADRs. ADRs are American shares of foreign companies. Now, you look at your investments and you go, well, I've got a bread making company in America, or I've got a paint making company in America, back to the paint making company, and you find a paint making company or a baker in euros. That's an ADR. So you can either just add that to your portfolio, or you can sell some of your American stock and buy the non-dollar denominated version of that. So you've got this nice portfolio and you're investing, but you want to be more short the dollar. You can go round and buy good stocks that are denominated in pounds, dollars, Asian currencies, yen, Thai baht, whatever, as long as they've got an ADR. So you're buying in dollars, but actually their performance will be valued in their foreign currency. So you are in effect shorting the dollar, but still nonetheless staying in the American market with an American broker with easy action stocks that you can buy and sell because they're big caps. So there you are, a simple way to go short the dollar but stay long equities. Now, of course, you UK investors can also do the same with American stocks, because there's the IOB section of the market which lists American stocks but has them listed in the UK market. So your UK stockbroker should be able to buy them for you. And of course, if you're wild spread better, you'll be able to get American stocks anyway, but using things like CFDs and spread bets, which, well, if it makes you money, it makes you money. I'll continue to keep you posted, and here is the omnibus. So Intel's been on the move for the last couple of days, and I hope you've seen my previous Intel videos where I talk about what's going to happen next. But I want to show you, to start off with, a graph that I think summates the opportunity here. And here it is. It's the chart of the Intel share price versus the general NASDAQ as a whole. And yes, isn't that interesting? So the story of Intel is now that Intel is on the comeback trail. So it's got some catching up to do. And if you look at the general NASDAQ and its performance, you can see there's plenty of upside to be had. And that's what I find particularly exciting. But why is it on this comeback trail? This is what I've got to say on that issue and what has been going on the last couple of days. Now, I've got strong opinions on Intel, and a few months ago I predicted Intel would go at some point ballistic. And the reason I predicted that back in, I think it was February, was because it has a large number of fabs in the US and in Europe. And the leading fabs that make chips for people like NVIDIA are in Taiwan or China. Now, that is not a strategic future for America, because it needs to be able to make its own chips, because if it gets in a conflict with China, it can't afford not to be able to make its own chips. And if you think about it, the near future and the medium-term future is going to be about who's going to be number one in AI. Well, America can't be number one in AI if its chips for AI are made in Taiwan or China, because in a conflict, those chips are going to go away. So it has to have chip-making manufacture amongst many other kinds of manufacture, which America would need so that it can actually partake in a conflict onshore. And Intel is really right now the only solution to onshoring chip fabrication in America. Because of that, it goes from a very, very I wouldn't say successful, because it's very successful. It makes billions and billions of dollars worth of chips, and that's an incredible achievement. But it's unpopular. It's been a dog of the chip manufacturing industry. America has realized this absolutely critical vulnerability and has stepped in. You could say Trump, but I think it's been coming for some time. If you look at the CHIPS Act, which was a Democratic act, it foreshadows what's happening now. So America has invested in Intel, so SoftBank. NVIDIA is going to be doing the same, and there's likely to be more of the same coming. And apparently, Apple's going to make an investment. So the rumors are. But it doesn't really matter. The die's cast. Intel is now going forward and is going to become a critical part of the US chip infrastructure. Now, when you think that an NVIDIA is 30 times sales and Intel is 2 times sales, or maybe 3 now, since it's gone from $20 when I said it was going to go up and it's now $33, it's going to go to somewhere between 50 and 60. That is my prediction. I might be wrong. I do have quite a lot of it. But if you look at this chart, you'll see where I'm coming from. At 4 times sales, which is really cheap for a tech company, you're looking at $50 to $60. Now, if it went to 10, which is also normal for high-tech companies, well, it will be 3 times where it is. It will be $100. If it was 30 times, like NVIDIA and companies like ARM, well, you can do the maths. That's not really likely to happen. But Intel is on the comeback trail, and it's going to be on the comeback trail for a long time, because the die's cast. There is no real alternative, not for years, for the building of bleeding edge chip fabrication. And America has to go with Intel, because Intel has the fabs. And these things, not only do they cost billions, but they take years to build. And Intel is really the footprint of chip fabrication in the US. And that is why it's on its way. And it will go a long way over the next 2 or 3 years, because this is a strategic thing. And strategic things create trends that are established and go on and on and on. So the future for Intel and its share price is really very exciting indeed. And again today, you've seen it break into a new high. And this is a chart. And this chart gives you an indication of where it's going. And I produced one that said it was going to go exactly here only a few weeks ago, and it has absolutely done that. So up to now, I've been relatively accurate. You can see my previous videos on the subject, which came out before this happened. And I'm very pleased to say I've been calling that. And this is my next call of what's going to happen. In my opinion, we'll probably get a bit of consolidation here, but we might not. And we're off to $50 to $60. That's why, where, and the only bit we're not really sure of is when. But when it's probably going to be soon. Well, I'm going to go for a gap. I wonder if I'll make it. See you on the other side. Nope, I'm a bit bigger than I was in the past. Not going through that gap. Oh well. So one of the good things about being in the markets, if you get it right, and that can be your main activity, you can do it anywhere. But right now, I'm actually in Greece, on a Greek island, overlooking the blue Aegean seas. But anyway, I've got a tip for you. I think it's pretty good actually. And I do own this stock. And this is not financial advice. This is just an opinion and raw material for you to think about your investments. So this rant is a quick heads up about a very interesting copper mine in Poland called KGHM Polska, which is 35% owned by the Polish government and a huge producer of copper and silver. So here we go. And by the way, it really is a great thing that I bought from Mr. Musk, and that's the Starlink Mini, because really it's fantastic. It goes anywhere. You can plug a battery into it and it can last 4 hours, like in your rucksack or live streaming in the middle of a field or something. But anyway, here in Greece, take it out of the suitcase, plug it in, bang, high-speed broadband internet in the middle of nowhere. Fantastic. I've got a tip for you, and I've been looking at copper mines because, I've been going on about copper, and you can see that in my earlier broadcasts. And copper is going to be a thing. If you look at shares like Freeport-McMoRan, which has had a bit of an accident, and if you look at Anto Famagusta, they're already pretty expensive because the market knows what's coming next, and they're going to get a lot more expensive. So I've been looking around for big copper mines which are cheap, and of course, funnily enough, difficult to find. I think I found one. Now it's going to be quite difficult for my American viewers to buy on if they fancy it, because it's listed in Warsaw. It's called KGHM, and it's a very large copper mine in Poland. Now it has various interests all around the world, but a large amount of its mining is in Poland. It gets about 1 million tons of copper a year. Well, I think it's 750,000, but a lot of copper, and a lot of silver. Is something like 3 or 4% of all silver mining comes out of its mines. So silver and copper. And in Europe, it's a European copper mine, and with supply chains under pressure, you really do want your supply nearby where you're going to use it. And the crow agrees. This is a very interesting copper mine for those that want to invest in copper. Now, you don't have much choice. You've got Anto Famagusta, you've got First Quantum, you've got Freeport-McMoRan, and there's a couple of others which escape me right now. But this is definitely a pure play copper mine with a large chunk of silver thrown in, and it's in Europe, within the borders of Europe. With the idea of ever-increasing global tension coming along, and supply chains getting shorter and shorter, or having to get shorter and shorter, a Polish copper mine, that's a good thing. And it's cheap. It's 13 PE, not 23 or 30 like the other ones. It's got 30% of its shares owned by the Polish state, so it's a proper company with proper shareholders, and it's valued at 1x sales. Now I think Antov is valued at something like 4 or 5x sales, and Freeport is 2x sales. So you could say it's a half price copper mine if you can get hold of the stock, because obviously it might be quite difficult for you to get it if you're in the US. But there are brokers that support international markets, and you can trade these sort of shares on platforms like Interactive Brokers. That's my idea of the day, and I thought you'd like to know about it. As I said, it's my opinion. I do hold the stock. It's not advice, it's not a tip to say go out and buy, but it's a very interesting copper mine, European based, with a global footprint, but large amounts of copper production in Europe. So for a European supply chain, it's pretty good. It's big, and it's got a lot of silver thrown in too. That's a very strong reason to have a good look at it. And it's basically valued at half the price of Anto Famagusta and Freeport-McMoRan and the other ones. So it's also definitely in the value bucket. And you can understand why, because it's quite hard to buy shares on the Warsaw Exchange. And I'm in Europe, so I've got access, but it would be quite difficult, would take quite a bit of effort for an American investor to go and do that. But it's there, it's listed in Warsaw, and it really is a copper value stock right now. Ruined capital. So hello there, this is another rant from me, and this time it's about staking out stocks that you're going to want to buy perhaps potentially in the future. Now it's all well and good being told, oh, this is a great stock, it's gone to the moon, it's going to go even further. But sometimes that works, Nvidia, Apple, etc. But it's much better to find a stock when it's cheap, when it's at the bottom from a large fall, or it just simply hasn't gone anywhere for quite some time when it could. So that's how I like to play it. What you do is you see a stock and you go, oh, that's a good stock. Oh, look at that chart, that's terrible. It's, falling out of the sky. I'm not going to buy it now. I'm going to leave it. I'm going to wait for it to bottom and then trade sideways and then basically be a dead donkey. And then when something happens, when there's a catalyst and it ticks up, or I read the news that says good things are going to happen, I will then consider buying it then. You make a list which you watch, which you like, which you think are going to turn around at some point, and then you just sit there and watch and watch and watch and wait for the right time. Now you can, of course, and I do this sometimes, but it's not recommended, buy a little bit, let it fall more, buy a little bit, let it fall more, buy a little bit, and average down. But that takes a certain attitude, and you really have to be pretty contrarian to do that. And it's often better just to watch the thing and then wait for the moment when it's obvious to you, who's been following it for quite some time, that the tide has turned, and then you buy in. So this is a category of stocks that fit that way of doing business absolutely beautifully. Now, back at the beginning of the year, the Trump administration basically said to Europe at a big speech in Germany that they had to deal with Putin, while America was going to deal with Asian issues. Well, China, right? That's the translation for Asia. And well, what happened next was the European defence stocks exploded. And that was very nice because I had already bought a load. The moment I heard that speech, I went, oh, got to buy some defence stocks, and bang, up they went. Now, let's look at America. They haven't gone to the moon yet, but I got a sneaking suspicion that they will. When? Who knows? But anyway, this is a list of stocks, all military stocks, to watch, keep an eye on, and see how they trade, and wait for that moment where you look at the chart and you go, whoa, that's on the move. And then that's the time to consider whether you want to buy them or not. Now, I'm very bad with lists. I can normally remember half of them. So when I'm looking away now, I'm looking at a list of stocks which fit the area of pure play military listed stocks. I'm going to start with tier 1, because tier 1 is the big boys whose names you know. So anyway, let's have a go. So Lockheed Martin, I can forget the first name right, Northrop Grumman, Raytheon, General Dynamics, L3 Harris, Huntington Ingalls, and Textron. Now these guys are somewhere between 100 billion and 20 billion. They are very large companies. But if you look at them, they're not expensive. So the S&P 500's PE average is 28, give or take. And these numbers can pop up differently depending on where you check, but let's just call it roughly 28. And the average dividend is 1.2, 1.3% a year. And all these companies pay dividends, which is, I always feel is a rarity in the US. So when you look at the dividends and you look at the PE, there's some standouts here. And let me read off the list. I've got Lockheed Martin at 18 PE, which is not quite half of the average, but, it's pretty low. And a dividend of 2.8. So effectively, double the dividend, not quite half the average PE. So if you look at Grumman, that's 21 PE, so that's suppressed as well, because, you know, if it went up to 28, that would be a 30% profit, and they pay a 1.7 dividend in and around your average. And then you've got Raytheon 26. So Raytheon is more like the average of the S&P 500. And, you know, Raytheon is a big, hairy deal. General Dynamics, 22. L3H Harris, 28. Huntington Ingalls, 14. Yeah, paying a dividend of 2.3. And, you know, and I tend to look at the dividend because I think the dividend is quite a good indicator of relative value. Because after all, you're buying cash flows, aren't you? And if the cash flow is higher from holding it than the average, it tends to suggest it's cheap. And it can be cheap for a good reason. It can have had a horrible year and is never going to pay that dividend again, etc. But overall, an elevated dividend above the average is a sign of potential upside in the actual stock price. Now, that's tier 1. Now, when you go down to tier 2, it gets quite interesting. It gets quite spicy, because these are the smaller companies, you know, the sub $10 billion market cap companies. I'll just read the names. AeroVironment, Kratos, which we'll come back to in a minute, BWX Technologies, Mercury Systems, one that I can't pronounce. I'm going to try, but apologies. Ducommun. I don't even know if it's a stock. It just came up on a list that I was looking at. V2X, or was it VZX? Nope, definitely V2X. And Spirit Aerosystems. Now, I wouldn't play in this zone because they're small and they're spicy, but that's where the moon stocks are. And if you look at Kratos, for example, they've absolutely gone to the moon already because they're in a sexy area, drones, etc. So for the trader, the second tier is where the fun and the spice is. For the investor, the top tier is where the interest should lie, because there you're looking at 20, 30, 40% uplifts potentially, just with the market being normal, let alone with the potential upside of global tension rising and then suddenly the military stocks are in favour. Because when stocks get in favour, they don't trade at 1 and 2 times sales like the big boys are trading at. They trade at 4, 8, 10 times sales. But anyway, that may never happen, and in a way, let's hope it doesn't. However, if you're a value investor, if you're a contrarian value investor, a company in the States that, like Lockheed Martin, that are paying 2.8% dividend, well, you know, that's pretty interesting. So Lockheed Martin's paying a 2.8% dividend, which is, you know, a nice fat check. It will certainly pay for a few nice meals out at night if you take a decent sized position. And with a PE of 18.9, when the market is trading at 28, well, you know, that's a very, very appealing stock. But the thing is, you have to watch the price, you have to watch the chart if you are interested in that deal before you jump on in. Now, it might be someone like me, I'm looking at that and I'm going, that's nice, that's nice. But not quite cheap enough for me to go, yes, that suits me, I'll have that. So you then just stake out. In fact, you stake out all these companies, because when the dynamic changes, the chart will change. It'll stop going tickety, tickety, tickety. So they go, and then you go, oh, look at that, something is going on. And then you decide whether you're going to buy in or not. There's the idea. In a nutshell, companies that you like, that you feel are cheap, that are in a bear market for their stock, that are going down, 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 or for that matter, sideways, 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 don't buy them, watch them. And then when you go, I just got to buy this stock, it's going, then you can buy. And a sector for that right now is the large cap tier 1 defense stocks. And amongst those military stocks are clear and obvious value. So there's yet another reason to keep a very close eye on them. Because at some point, if something happens, the first people to know won't be us. But the first indicator that something's coming will be these stocks, because they're the ones that will suddenly start to behave differently. And of course, you don't even have to buy them. You could look at Lockheed, if it ever goes like that, and go, oh, that's not good. I'm going to buy some gold. Because it will be an indicator that something bad has happened and that global stress is going to go up another notch. And of course, that's early warning. It's a canary in a coal mine. So you get 2 for the price of 1. You get the opportunity to get in early if things start to move. And two, you've got a signal that things like Bitcoin and gold might be a good thing to load up on. I hope this was useful. I hope this was helpful. Thank you very much for watching. Please subscribe and like, because it really does help. And I'm very keen for us to get more subscriptions, because there's all the things that YouTube want to see on the channel is attached to that. And I'll see you again soon for another rant. Bye now. So by the way, this is Kos, a Greek island near Turkey. And it's about as chilled and laid back as you can get after the tourist season ends at the end of September, because this is October and most people have gone and the weather's still lovely and it's laid back as you can get. Hello everybody. So a bit of housekeeping news, in fact very exciting news. I launched a new FN yesterday and it's in soft alpha launch. So anybody that has registered to be able to use the site has been allowed in. Now, as you're in a select group of people, you can go to a new FN and you can register or put your name down on the wait list, but go ahead and register and go in and have a look of what I've been up to over the last few months. Now, it's very much UK centric at the moment, but it will have US price feeds in there in due course. So go have a look, see where we're coming from, where I'm coming from, and please email me if you've got any ideas, because we're going to be building this site on the ideas of users, plus mine, of course, and plus the teams. But really, we are there for the community, not the other way around. So please check it out and feedback. Now, if you've seen my earlier videos, you'll note that I've been raving about Intel for some time, and I started raving about them around $20 a share. They're now 37. So, and that's, well, let me start again on that. And that's really not over a long period of time as far as these videos are concerned. But I started to write about them back at the beginning of the year because it was obvious to me that Intel had the bulk of onshore US and European fabs. And while they were looked down upon by everybody, and while everybody was saying they're not such a great company, they had the only solution to America onshoring chip manufacture in the short and even the medium term, because fabs cost fortunes and take years to build. And Intel are the big footprint when it comes to fabs in the US and in Europe. And it's no good having a fab in China, is it? Or for that matter, Taiwan, is it? Or even Singapore, for that matter, if you're facing off against China. So with the Trump versus China theme, Intel's the only game in town for chips, and chips are the only game in town for any sort of dominance. And AI is the big thing, and there's no second place in AI. And if you don't make the chips onshore, you're going to lose, aren't you? So the only way is to have fabs onshore, and the only fabs at scale are Intel. And although they're a little bit behind the competition as far as making chips at the small nanoscale, they're very close and they're catching up fast. So the idea was they would get into fashion because it's the only game in town for onshore fabs. And lo and behold, the American government comes in and says, right, here's some money. We want 10% of you, and, you know, get on with it. And ringing up people like Nvidia, no doubt, and saying, do a deal with them, will you? Oh, Apple, yeah, do a deal with them, will you? Oh, XYZ company, do a deal with Intel. We need to get these guys off the starting blocks. We need to get geared up for onshore chips. So hence, as soon as Intel and the US government got all huggy, the share prices exploded. It's at $37.30, which I think I'm sitting on something like 70 or 80% profit. Now, people keep asking me about, you know, when to get in and when to get out. And that's market timing. That's extremely difficult. But when you are sat on a rocket, like Intel, when do you get off? Do you hold forever? Do you wait for 10 times sales? Do you wait for sales to double? I mean, personally, I think the next stop is 4 times sales, which will put it in the sort of $50 to $60 range. But I know a lot of people, particularly in the US, believe in buying and holding forever. And that turns out to be a pretty good strategy. So if you're a buy and holder and buy the dipper, then you've got no worries. You'll just sit there and watch the share price and hopefully watch it go to the moon and not lose a night of sleep. Now, if you're a market timer, that's a very different world, and it's a much harder world than just buying and holding. And I'm a market timer, and for my sins anyway. So this is what I will do with Intel. Now, I like to get out and take my profits when they're fat, and I used to take them always automatically at 30%, because that was what Benjamin Graham said you should do with this sort of situation. Well, I learned over the years to hold on, because these things can run and run and run and run and run. Now, this is how I would hold on in this situation, and probably how I will be holding on if I don't go, I've got a lovely profit, bye, at $60 or $50 or whatever. I will be drawing a trend line underneath the share price, like this. And when it stops going up that trend line and starts to make a sideways pattern, I will draw a line like this. And if it goes much below that line, I will be thinking about getting out. Now, the theory behind this is as follows. You have a share and it's in equilibrium as far as the world's concerned. It could be sentiment, it could be fundamentals, who knows what's causing it, but it's at equilibrium and it's going sideways, as you could see when it was down at 20. So it goes to 22, it comes back to 19, it goes to 21, etc., etc. What you're looking for is a breakout from that equilibrium, because when something happens to shift the equilibrium, you're going to get a repricing. And when it reprices, it's just going to go, or it could go, of course. Yeah, it goes bang. And then it hits another equilibrium point. And that's where the market players go, oh, maybe I should buy. Oh, maybe I should sell. I don't know. Sell a bit, buy a bit, sell a bit, buy a bit. Or, oh, I'm waiting. Oh, this has been good, and I think this is going to happen next, but I'm not allowed to trade because I'm inside. The news is out. Bang, I'm in. So you have a new equilibrium, which is in a range, and that range is the range of uncertainty. So the tighter that range is, the more certain the market is. And if it's gone up, you can imagine that it's a high probability that it's going to go up further, because the market is pretty comfortable with this point, and it's pretty comfortable that nothing bad's going to happen. Okay, so you draw a line underneath that. And you say, if it goes through, something's changed. You know, if it breaks on down, something I'm not a party to has happened, I'm out. Okay? But what is likely to happen is something else will occur. So maybe they're coming out with a new chip and it's coming out on, October the 1st. But they're not sure, because it's been promised by Friday and maybe it's not going to happen. So everyone sat there waiting, and then October the 1st happens, bang, there it is. Up it reprices again. So up it goes. So you draw another line and it stops, and then it starts to go sideways again. It's got a new equilibrium. So you follow these equilibriums and the repricings all the way up until you go, I've had enough, or I think something bad's happened, or in my mind, we're in a new reality, or in my mind, I can't sleep at night because I made too much money, or in my mind, I'm scared about the downside. Whatever reason to get out, you get out, because there's always another bus coming along. It's not the only share. Of course, you can look at Nvidia and say, oh, look at that. If only I bought it at nuppence and now it's a bazillion, I would have made, generational wealth. You could look at the same with Apple. But generally, those stocks are lottery tickets. And if you can spot them and you're sure that's what they are, then yeah, hold forever. I remember I was in a bar in New York and a young lady was saying to her advisor, oh, Apple has gone up a lot. I don't know what to do. What should I do? What should I do? And I was sat there thinking, you should sell. And of course, it went up about 30 times after that. So market timing is a very, very difficult thing. And I hope she held and hope she still holds. But those sort of situations are uncommon. And if you're sure you've got one, keep it. And if you're not sure you've got one, then you have to look for the signals of when to leave or what the situation is. And this is a good way of doing it. So you follow the trend, you follow the equilibrium, and when it breaks out, you make a decision. I mean, if you are a trader, if it breaks on up, you buy more. I would never do that. I've done it very rarely, but I would never do that. I just buy my position and just hold and let it run. But if you are really risk hungry, when it breaks up, you buy more. So, that's the way that the people with more nerve than I have do it. But that's the way to trade this sort of rocket. And I hope you enjoyed this little run around how to handle technicals when you've got a moonshot stock. And there'll be more videos like this coming up soon. Thank you very much for watching. Please subscribe and like, because that really does help me. And please pop on into A New FN, link below, and check it out and tell me what you think. See you soon. Bye now. Hope you enjoyed this. Please subscribe and like. That's kind of really important for this channel. See you again soon. Thank you very much for watching. Bye-bye now.